There isn't really a bid right now on oil. What's the outlook?
It's not very good, Betty. It's going to be at least a half year before oil prices recover, I think, because we really need to see some major changes in the industry. A lot of the production that we've kind of ramped up over the last 3 years, some of that had to start coming offline before oil prices will recover at least a little bit.
Well, and just today, we had news out that Iraq and Russia are stockpiling the most oil that they've had in decades, right?
So the Russians are at a full tilt. They're producing more than they ever had before. The Libyans, on the other hand, have had a big problem in their production over the last week, but that hasn't mattered to the market. A lot of the things that we used for the last 10 years that seem to matter to oil don't really matter much at $53, one of them being a supply problem from Libya. Things like that, they don't seem to register anymore.
What ultimately is going to matter? Because you talk about the potential for supplies to be taken out of the market if, say, the marginal shale producers have to shut down at least for a period of time.
Right.
At the end of the day, though, the reason that that's happening is because of Saudi Arabia, isn't it? Isn't it all up to the Saudis?
I think there's been, I think there's been quite a perfect storm here that's caused prices to drop. I don't think the Saudis are the least important factor, but they are only one of the factors. We've had a rising dollar. We've had very bad economic reports from China and Europe. We've had a number of shale players who have sort of overrun their ability to produce.
Let me put it to you this way, though. If the Saudis on November the 27th had made a different decision, where would oil be today?
I think it would be a little bit higher, but not much.
Really?
Yeah, I think that this is just one of several factors. In fact, I think the Saudis have sort of decided themselves that they're going to be just one factor in the dropping price of oil here and then be part of what will be a recovering price of oil. I think a production cut will come, but it will come in the second half of 2015 when they can again reestablish themselves as the swing producer, as the global swing producer, as other producers kind of pull barrels off the market. They can stand there and again be the arbiter of global prices.
So, Dan, how do you play this plunge then? What's the most effective way?
Well, there's a way to play it long term with those E&P players who are not marginal, the ones who I really believe are going to make it through the rain, let's say, and really going to come out the other end as strong, if not stronger. But for now, the first half of 2015, you really want to stay away from a lot of the producers. One way to play it is with refiners who benefit, obviously, from a lower crude price. It's like making corn flakes. If you're Kellogg's, if the corn price goes down, it's obviously cheaper to make corn flakes from it.
Right.
This is what refiners will benefit from. Some of those that have good access to these very cheap crude supplies that are coming online, and in fact have some other, sort of tax tricks that they can use, dropping down into sister MLPs, things like that. Those are the ones where you want to go.
What about some of the pipeline operators?
I think that's a good way to play. One of the problems, of course, is that with a lowering production portfolio, you're going to have less of an interest in increasing the infrastructure. Pipelines won't get built, so you have to pick very carefully about which MLP or pipeline companies you want to play. I think Kinder Morgan still remains one of the best in the space and one of the safest, and so KMI would be one I would go to there.